Hey everyone, welcome back to Mark Loeffler Experience. We got friend of the show, Andrew Hines, back. And if you haven't checked out Andrew's podcast, you can check that out on Apple and download that on Spotify. And always great value, and we're happy to have you back. Thanks, Andrew, for coming back on.
Thanks for having me.
I mean, this is basically our monthly show.
Yeah.
We should call it the Andrew and Mark Market Update. Yeah, we're just going to go through a whole bunch of stats and some fun stuff that we like to geek out on and make some magic happen.
Yeah, so we were talking about this before, just going through the map of the country, see how different areas are looking. It looks like year over year, as of right now, we're up about 18%. From last year.
But that's a national average?
National average, right? So the different cities, depending on price point, as per usual, the lower price cities seem to have gone up more.
In Ontario?
In Ontario, yeah.
Because now I'm looking at Edmonton here, and we're at 5.5%.
Right, Edmonton's much more normal growth, right? So that's the opportunity city as you see it, right?
Calgary's 9.5. Hamilton. Everyone loves Hamilton. 30%.
Mm-hmm. And London's right around 30 as well, 33, I think we said.
33, yeah.
And London was traditionally one of those more affordable towns. Like, you know, that's the common thing I see in Ontario is all those really affordable towns just became a lot less affordable because, hey, people know, right? If they see an opportunity, if they can work remote, why not?
Is that actually correct that Sarnia only went up 6.9%?
I don't know how that's possible, but
that's year over year. So it might have had a huge spike and then's leveled off.
Yeah, a huge spike the previous year.
But I do know people out there that are buying. They're saying they're getting great deals.
And I'm even building out that way, and I have my kind of ear to the ground, and I'm hearing some pretty ridiculous numbers for things that used to be worth 100 or now worth 350. Over a 5-6 year span. So apartments. So definitely some changes happening. But interesting to see that they're not quite as aggressive in the growth.
Yeah, Prince Edward County, or Prince Edward Island, sorry. 14.7%. Does that number shock you at all?
So the 14.7 doesn't really shock me because Vancouver was the most expensive city in Canada to begin with.
I still think it is.
It is still. So like I said, I think the more opportunity markets, the ones that are more affordable, people are just migrating. But of course, you're still going to have a certain amount of demand in these cities. So it makes sense they continue to grow, but not as fast.
Do you think some of that might be that we're not seeing as many foreign people buying right now just because of immigration and that type of thing? And that's largely what was talked about driving that market.
Well, our immigration is opened back up, is it not?
It has, but I don't think the floodgates have opened yet. So it doesn't feel like
so. The goal is still the 400,000 a year over the next 3 years. That's the stat I heard.
Yes, that's what
I think we all know, though, everybody who thinks about immigrating to Canada, they're thinking Toronto, Vancouver, Montreal, potentially, primarily. Yeah, exactly. Those three cities. Then they get here and realize, oh, wait, my money doesn't go very far in those cities, and then they kind of scatter.
Well, I mean, that's why Southwestern Ontario, I think,
right.
I feel like, there's huge populations of most immigrant groups, right? Yeah. So they can go to Hamilton, they go to St. Catharines, they can go out east.
Hey, my grandparents migrated here from Holland. They immigrated, and they went to Tilsonburg, of all places. Well, like Mount Elgin, if anyone knows where that is.
Nope, nobody does. I'm going to get a comment down below. I'm in Mount Elgin, it's right here. And anyways. Saskatoon, 5.8. So obviously the Prairie Province is not doing as well. Let's check out Winterpeg.
Winterpeg. They're a bit of a tougher sell, right? The central provinces, they're obviously not the ones that people hear about, right? They come to Canada thinking Ontario, thinking BC, thinking Quebec.
Yeah, if this is just an immigration play, which, to be honest with you, I don't think it is. I think a lot of this has to do with people from, say, Toronto, and they're now saying, "Oh, I don't need to live in Toronto.
Yeah,
I can live in Bancroft. I can live in London. I can live in these outlying areas because I can sell my house in Toronto for an average price of 1.1 and buy out there for an average price of 400,000.
Right. Yeah. That's like we say, water goes to the lowest point. People see it's expensive there. Why retire in Toronto if you can just move out of the city? As it gets further on. And I think we see that too from the beginning of the lockdown. We saw that people wanted out of the city. They wanted more space, especially if you're not able to do quite as much. Now, of course, things are opening back up and the cities are becoming a little hotter again. And obviously that wasn't going anywhere permanently.
Yeah, I mean, Greater Toronto, it's not great, but it's better than average, right? I think it was up 24%. Yeah, 24% year over year, which, it's actually coming close to being the most expensive city in Canada.
Right. So a consistent climb for Canada. We don't have the breakdown for individual cities right here.
No.
But I can say, like, anecdotally, what I've been hearing just from, one of the realtors I was speaking with recently is that ever since the announcements of the interest rates climbing, we're seeing a lot more activity in the housing market. And I think that makes a lot of sense. If people are anticipating interest rates are going to go up, they kind of want to get in now. And maybe that's driving some of it. But I've also been taking a look and seeing that our inventory is down pretty much across the board in every city, active inventory, in terms of number of months of inventory. So I don't know if you have a stat there to show that. So new listings looks normal, but then there you go. But then when you go to this chart, it tells the story. So if we look at new listings, things kind of look normal, and then you look at the months of inventory on the market, and that's where the problem really lies. So that means we have a seller's market pretty much across the board.
Well, yeah, and I mean, here's the funniest thing, right? Or funniest thing. I mean, you can see that we're below where we were last January for inventory level, for months of inventory, and you can see like sales to new listing ratio of 90% in January. So 9 out of 10 homes that listed sold.
Yeah, in that month.
Yeah. I mean, that's huge. That's never...
We're not that high now, right? Now we're 80%.
We're
so
80%.
8 out of 10 homes sell in the month they're listed then, basically.
Yeah, but basically we're back to where we were in December last year, where 8 out of 10 homes are selling.
So are you thinking it's about to take off again?
I do. Well, I mean, so like we were talking before, historically during this time, the inventory levels go down. People are celebrating holidays. You know what? We're in Canada. It's colder. People don't want to move when it's cold or have people in their house when snow and that type of thing. And inventory levels typically go down through the winter months.
Right. Yeah, there's a natural seasonality. And usually we'll see price come down a bit too in the fall, winter, and then pick back up in the spring. That was traditional. Maybe a few years ago. We haven't seen that in a little while.
I don't think we've seen that for about 5 years.
Yeah. Well, no, ever since late 2016, nothing's been normal, we'll call it.
Nothing's been normal, yeah. I remember back here, I was telling people to buy.
Yeah.
If you had just watched my videos, I mean, they were crappy quality. I didn't have all this fancy equipment, probably horrible sound. But if you had done that, you would have made a hat.
Yeah, back when everyone was panicked, the first lockdown, no one knew what to make of it. I think there was a lot of fear. Hey, myself included, I didn't know how long it was going to last and what impact it would have. We were down like 1 month until things picked back up, right? It was like 1 month of...
It was mid-March.
Yeah.
And then it was late April to early May is when things started. So we had a good 4 to 6 weeks. Yeah. Where if you just bought during that time, you look like a genius.
Yeah, you look like a genius.
Well, here's the thing. If you bought in May, if you bought anything in 2020, you look like a genius in 2021.
Mm-hmm. I tied up a house right as that was starting for $750. And I assigned it, made a little profit. And I think the appraisal on that house after it was reappraised was like $1.3 million. Like just like a $200,000 rental. Yeah. Like that's how much wealth was transferred in that little time there.
Huge.
Yeah.
You're talking about interest rates rising, right? Obviously bank rate's not doing anything.
Yeah, the overnight rate.
Overnight rate. But okay. Like, yeah, we're up from the bottom.
Right. Well, it's more the anticipation, right? Like they're talking about the bank changing their rates, which would potentially affect all the central bank, which would change all the commercial banks' rates.
Yeah, the fixed rates.
Yeah, the fixed rates.
Well, so the bank rate really doesn't change the fixed rate. That's due to the bond market, obviously. Right. But the bond market will.
Well, it's all interconnected. Yeah. So people are anticipating interest rates are going to go up in the future. It's not so much that they've gone up now; they've gone up a little bit. The fixed rates are still very, very reasonable and attractive.
I mean, I'm just looking. Low twos. I'm just looking at this, looking at the chart here, and be like, I mean, we talked about that was unsustainable. I mean, one and a half, like that's. Again, that was free money. I told you, you lock in and you do whatever.
It is free money now. Like I'm more convinced than ever, right? Because like we all know inflation doesn't factor in everything. If they're willing to admit to 5-6% reasonably, it's much higher. So if you're only paying 2 or 3, you're getting paid to borrow. Yeah. Especially if you're borrowing it against an asset, right? Like the bank's basically eating that loss of value of the capital. So I mean that's an advantage if you can cash flow and get in.
Well, they would lose more if they just kept it in cash.
Yeah, exactly.
So they have to lend it.
Yeah, okay, fair enough. I mean, but they can lend money they don't really have through fractional reserve lending. So
100%. So they're still making money.
That's the business to be in if we're not kidding ourselves.
Well, 100%. I've always said it. I want to own a bank.
Yeah, exactly.
Like if I can lend 10 to 1,
Well, it's a
100 to
permission
1,
to
yeah.
legally create money, right?
Yeah.
If you or I do it, we're criminals. But if they do it, it's all by the book.
Yeah. So if you can help Andrew and I set up a bank,
Yes, we're into
comment
that.
down below.
Yeah.
Hit me up on Instagram. We'll talk.
Can we form a credit union? Maybe we can do something like that.
It's actually easier now. I was
Yeah.
looking into it a couple years ago, actually, very seriously. And yeah, anyways, we digress.
I think we got enough pull between our audience here. We can make that happen.
I think it was 50 million.
50 million?
I think you needed 50 million. And here's the thing. So everybody always wants to know, so this is what's happened, right? This is in the past. Where are we going in the future?
Well, I think we said last time, my prediction was a 5% gain over from last month till the end of the year, which I think we're probably still well on track to do. And then next year, I think we're again going to be above 10%.
And
increase.
you're talking basically Ontario.
I think nationally we're going to see 10% plus increase in average property value, if not 15 to 20. I think that's all possible, but I mean, I think that 10% is kind of a no-brainer. Of course, we always have to watch out for that unknown event, something that could, cause a massive shift in demand, right? Because when we have the immigration plan, when we have the money printing the way we do, there's so many factors, forces that push prices up. So what is it that's going to bring them back down? And it's that unknown event. It's irrational fear. Like, for instance, when the first lockdown happened, there was no rationality to it. It's just people panicked. Obviously people still need a place to live and always will.
Yep.
But that's where we always come back to that riding out the waves, because you never know. Just because we think things could rise, there's always that element of the unpredictable.
Yeah, and what would some of those factors be in your mind that could throw that?
Well, there's always another event like our nemesis of the last 2 years, something like that happening.
Complete lockdown.
Yeah, another lockdown from another virus or from the same one or a variant or whatever. I think but people are kind of almost immune to the idea of that affecting real estate prices at this point. Natural disasters, things like that are certainly on the table for things that could affect.
So flooding in BC?
Sure, flooding in BC is obviously going to affect their market. Now, the other element is, I've always linked it back to this, an event that could cause people to lose their pensions. When fear is instilled, when people get afraid enough, especially if they're in an older age and they have a significant event that threatens their retirement, they change their spending habits, and that's something that doesn't just flip back. That could take 5-10 years to recover. So
if they live through the Great Depression.
yeah, exactly. So I think that one of the things we have to be cognizant of is that events in the stock market, although it doesn't happen as quickly in terms of how it affects it, if there were to be a big crash there, that would certainly translate into the real estate market because of fear. It all really ties to that.
You don't think like a huge interest rate change or a spike? I mean, if they do come out and say or inflation's 10%, and they're like, "Oh, we're going to crack down," they're going to go like 1980s Jimmy Carter on us type thing.
So I'm glad you brought that up, because that's one of those things I forgot to mention here that could definitely have an effect, and that's one of those things that I'm a little worried about, is that they let this ride, and then they finally admit the truth. And then the only thing you can do when you admit the truth is to jack interest rates. Like, we used to have like almost 20% interest rates for quite some time in the 80s, right?
I mean, your parents and my parents.
My parents. My mom, she went to the banker. She told me the story. The banker said, "You're in luck. We can renew you at 12 3/4 today." Mm-hmm. And that was like down significantly from where things were.
That was a deal.
That was a deal. So I don't think people could survive that. Which is the scary thing, because our government's in a tricky position, because traditionally economic policy, when your inflation rates get above 3%, the proper response is to increase your interest rates. But what we've seen is really a redefining over the last, say, 30, 40 years of actual inflation and what's included and what's not. So I don't feel that they're fully admitting, and I think you would agree, fully admitting to the true level of inflation. So what if they were to actually acknowledge what's really happening right now, and then react appropriately based on tradition, which would be to rise interest rates, and quite significantly to slow things down?
Yeah.
There's a lot of fallout, though, right? Because there's government debt.
I don't think they can afford it.
They can't afford it. So that's the thing. Like, it's like this perfect storm of crap forming.
Yeah. Well, I mean, there's monetary easing going on right now.
Yeah.
Like, they're not buying bonds anymore. Like, they're not buying new bonds. They're keeping up what they have.
Yeah.
So that obviously is why we saw a little bit of a spike in the interest rate, because less buyers for it.
Yeah. Yeah, that's the other thing. Yeah, we're governments affect the bond market by basically just buying up bonds when they feel they need to control interest rates. They do the same thing with gold and silver. Perceptions are everything, right? Maintaining, the calm of the public is everything. So it's up to people watching this show to read between the lines.
Yeah.
And put yourself in a safe position, because I think that if our portfolios as investors aren't set up to be able to weather a storm, it might not be a fun 5 years to come. But maybe I'm wrong about that, and maybe we're laughing.
I don't see any, in my mind, I don't see anything that will rock the boat that significantly.
Right? Yeah.
I don't think they can. I don't think they, unless something untoward happens that they can't control.
Right.
Then I don't think they want to rock the boat. I don't know if you watched my video last week, and does the government actually want lower house prices?
Yeah.
I don't think they do. I think
I didn't see that one.
I think this all plays into what they want,
which is
higher prices for everything.
Yeah.
They're trying to inflate their way out of their debt.
Okay.
Number one, and number two is I think everybody is just enamored with low interest free money.
Yeah, but that's like that Trojan horse, right? Like, oh, it seems great. You've got that low interest rate. You're into your home for a 5-year fixed rate. What happens at renewal? If by then they've made that adjustment, and then how many people are going to lose their homes at that point? I hope we don't go there, but I agree with you. It's like, how can they? But if you look back to the 80s, how could they have then? How could they have? They knew how catastrophic raising interest rates the way they did would be.
Did they? So here's the thing.
So?
Well, this is a whole nother story.
Yeah.
But they came off the gold standard. This and this.
Yeah.
Honestly, I don't think that they. I don't think they knew. I think they're just like, well, we this is our control. Here's our lever. Here's our sledgehammer. Wow.
Yeah.
And now they're more like, oh, we can't use the sledgehammer.
Yeah. You'd hope, right? You'd hope. I think that there'll be a lot of people with something to say if they do.
Well, and it was a little different at that time too, because a lot of that was oil driven too, right? Like oil was $10 a barrel, and then they had the crisis, and now it's $100 a barrel, or
right? Yeah,
whatever, right? I don't think we're going to 10 times oil.
Yeah, it's tough to say anything for sure these days.
Yeah. All right. So, we've talked a lot of stuff here today.
Yeah.
So you said your prediction for next year is 10% year over year increase.
Yeah, I think nationally. 10%. Barring any extreme event.
What areas do you think might do better than the others?
Well, sound like a broken record here, but I always think that the tertiary, secondary markets are the most poised for growth because they were the most affordable. So I look for the more affordable traditionally type of markets. I'm not going to go buy in Toronto proper myself, just because I don't think the cash flow is as strong. Whereas I'll see people going up north. They're looking. So many investors in our community are looking. North Bay, Sudbury, Europe, and Kirkland Lake doing stuff. These are affordable markets where people want to basically see their dollar go further.
And I'm going to disagree with you. I think we're going to see a rise back in the cities.
I think we will too.
I think they're going to lead the way.
I think there's still a greater advantage in some of the tertiary markets, but time will tell.
I think they're going to lead the way. I think you're going to see year over year higher increases in cities like Toronto, Vancouver.
Well, that's traditional. That is traditionally what we've seen. So yeah, you could very well be right. I'm very open to that possibility.
Yeah, me too. Because I have stuff all over. So I'm good
whatever
either
happens.
way. Yeah.
Well, diversify, right? Because at the end of the day, all we can talk is market forces. We can't predict the forces. We can just interpret them.
For sure. All right, everyone. Thanks for watching. Comment down below. If you agree with Andrew and I, who do you think is right? Let us know down below. Thanks, everyone. See you next time.